Thank you very much, and thank you all for joining us this afternoon. It's really a pleasure to be here today. I really want to start by thanking ICMA for just an absolutely incredible forum and event. I think there's been a ton of superb content over the last 2 days from market participants, regulators, and policymakers. As was mentioned, I've had the pleasure of chairing the Secondary Markets Practice Committee for ICMA, and what I've found really valuable about this is whether it's discussing electronification, MiFID, the Corporate Bond Purchase Program, CMU, standardized issuance, it's been invaluable to have a group of market experts that spans investors, issuers, the primary and secondary side of the banks, trading platforms, all come together to share their perspectives. And it gives us, I think, a unique opportunity with this forum to speak to the industry with maybe not one voice, but a coordinated chorus of voices. So I think that's a wonderful, wonderful opportunity. I'm very grateful for it. I'd like to start by introducing my panelists, who I'm thrilled will be joining me today. And they should hopefully be providing multiple perspectives on the evolving market structure in fixed income. There's a lot to talk about, so I will just kind of start with introductions. Yann Couellan is the head of fixed income trade execution at AXA. We have Deirdre Summers, the chief executive of the Irish Stock Exchange. We have Pauli Mortensen, Global Head of Trading for Norges Bank Investment Management. And we have Nick Bean, Head of Bloomberg Fixed Income Trading Product Development. So with those introductions, we'll get into our first theme. So, I was really inspired yesterday by Arunma Ote's presentation, and she cited several issues in the fragile economy, including, but not limited to, the low yield environment, changing regulation, unconventional monetary policies, low risk tolerance, and geopolitical uncertainties. So I want to start by asking you, Pauli, in what feels like a very fragile market condition, what is the intended role of fixed income in the real economy?
I think the main role for fixed income is still for investors to have an active class where you can invest for the purpose of diversification to the volatility we see in the equity world. For investors to be able to, of course, obtain interest rate risk, some degree of credit risk, and also be willing to pay a low premium in terms of a lower yield, in terms of this as a class to become able to sell it in the market at some time. So not like a loan, for instance. Mm-hmm. So it's tradable. So a possibility for investors to have an asset class where you can obtain those risk metrics and at the same time also be able to transfer risk out of it and into equities or real estate.
Great, thank you. I'd like to ask you, Deirdre, the same question. And as executive of the Irish Stock Exchange, you also have the perspective from the equity side, and I understand you also list corporate bonds. So how is the role of the fixed income market similar or different from equities, and where do you see its
Well, I think
future?
it's always good to, first of all, define the problem, and it's I think there's often a tendency to look at this as an investment product, but it's also a funding product. Mm-hmm. And Europe has very significant funding deficits, and estimates are that there's going to be about a 2 trillion equity deficit in the next 15 years, 1 trillion in infrastructure deficit. We're 75% dependent. It's a fairly cliched thing on bank funding. Of the 23 million corporates in Europe, only 11,000 are represented on markets. So I would say, and that is even before we get into pension deficits and having savings that are more diversified and working harder and delivering to the wealth expectation of the citizens of Europe. So it's not a question of whether fixed income has a role, it has to have a role. I think equity markets are trying to embrace their role in relation to trying to be more dynamic as funding mechanisms for enterprise and trying to act more clearly as a conduit between retail and institutional investment and the real economy. But I think that the bond markets have to start playing a more dynamic role.
Yann, how about you?
Globally, yes, I fully agree what has been said for the fixed income. It's clearly one of the key challenge to have fixed income in the real economy. It's a need. That's clearly when we see issuing a lot new issue in the primary market. That's clearly one of the big needs, and I don't see that exactly reducing going forward.
Great, thank you. So let's shift our attention now to electronification and the role that it has played in the market. Since the crisis, there has been a tremendous amount of innovation in electronification. I'd like to start first because I think that very word means different things to different people, and it also maybe means different things in different asset classes. So, Yann, I'm going to turn to you again. When we use the word electronification in the fixed income markets, what exactly do we mean?
So electronification is a kind of wide umbrella with different subsets. The most common understanding of the electronification when we talk to people is that e-trading, and more specifically RFQ protocols, which is the most used protocol currently. But it's also the market data standardizations, which is really important for us in order to increase the market information sharing and facilitate the exchange between market participants. Also, the additional thing is that the connectivity, the electronification is a big part in the connectivity to connect all the market participants. That's something which is very huge in terms of difficulties as well, and cost in terms of resources you need to put in place to connect people. But it also depends to which providers you want to be connected to. For example, some vendors, market data vendors, and also to new trading platforms which offer new trading protocol, which has, in a way, brand new, like the new crossing recently happened in the market. So that's something which is really a plus.
Thank you. And Nick, being at Bloomberg, Bloomberg serves many different functions within the market around electronic trading, information dissemination, data. What do you see as the tools and protocols that have emerged since the crisis, and how are they helping?
So I must say I was very pleased that electronification was used in the title of this actual panel. So many times over the years there's been panels related to e-trading, and I think it's important that we shift away from this concept of e-trading into electronification. And I can only support what Yann says. It's now not just about the act of execution itself. It's everything upstream and downstream of that. Importantly, I think the dissemination of information is going to play an important role going forwards. Obviously, under MiFID II, we understand that transparency is going to be regulated in the sense of its propagation throughout the industry. And indeed, I'm having many questions with our clients, and indeed, I'm sure you all are as well, about how to meet transparency obligations. But equally important is how you actually consume information from the transparency that's out there in the market. So I think with the consumption of information and the decisions you're going to make off of that, that will feed into the act of electronic trading, and then obviously then feed downstream into post-trade services. So electronification for this market, for me, or from my perspective, is less about siloed services such as analytics, then electronic trading, and then post-trade operations. And it's going to be more about the horizontal across all of them and making sure there's an ecosystem between those services.
Yes, I would have to agree with that. And I'd love to offer my 2 cents here from the sell-side perspective. I think it's similar to the things that each of you has touched upon. I was giving a presentation earlier this week internally, and we were just looking at the timeline of how much has changed since the crisis. And I would divide it into sort of 2 categories. E-trading, as I mentioned, then data as the other. And on the e-trading side, prior to the crisis, there was really kind of 2 models. There was, as we discussed, the directed, disclosed request for quote, where we knew which clients were coming into us and they knew who they were coming to. And then there was more of the retail exchanges, venues, and those are really the only 2 trading protocols that seem like they exist in the fixed income markets. Likewise, on the data side, certainly in the credit markets, our clients got information from us through runs, and maybe they had, a simple Excel add-in in Bloomberg, but it was really just that. And if you look at, since 2008, what has happened in the evolution, and I would argue that each has been pulling the other along. On the protocol side, on the trading protocol side, we went from, just the disclosed directed RFQ from a client to a dealer to the interest for the market to be able to RFQ all or RFQ clients to each other or RFQ anonymously. We then moved from there to many innovations around sessions and trying to create a street corner, if you will, of liquidity where everyone met at the same time, at the same place, to trade a certain subset of bonds or a sector. And then we layered onto that, well, let's kind of agree on the mid-price, and there was a lot of mid-price auction initiatives. And now we feel like we're into the next tier of evolution on the e-trading side, which is, I would call gray pools, where clients enter their information and start to get matched without giving up information to one another. And that, to me, is how the e-trading, I should say, evolution has been in the last 8 years. And then on the data side, as I was saying, we went from having runs that went to our clients to having message scraping and people, lots of different aggregators of that information. Dealers have gotten better now about aggregating inquiry from our clients to understand and have more targeted interactions when we come to you with markets. And likewise, I think our clients have gotten much better at aggregating the information coming from dealers. More and more, we have clients asking us for direct connectivity, either via their OMS or direct feeds. So really, a lot has changed in these markets that has to do with electronics, whether or not the volumes are trading via, e-protocols, whether or not that's changed significantly. So that would be my take on electronification. Pauli, let me turn to you. To what extent do you believe that this has been an organic evolution in the market, or how much of it has been regulatory or policy-driven, the changes that we've seen?
That's a good question. I think it's mainly regulatory-driven. And when I say that, that's because after the financial crisis, we all know the regulation came into place to fix the issues that the system had with financial systemical risk, and to deal with that. And that was regulation, and we had to pay a price for that. And the price for that was that the market makers could not now offer the same liquidity to the street as they'd done in the past. For me, as a trader or portfolio manager past 2008, liquidity was, a very small issue. Few bonds, a few markets, it was an issue, but in most markets, I got all the liquidity I could get from the street, from the market makers. Mm-hmm. So in a way, you can say that those who created prices were the investment bank community and the dealers and the interdealer brokers, and they created sufficient amount of liquidity. It was no issue on the buy side to implement investment strategies because the liquidity was there. Then post-2008, the financial crisis, we all know the story. They could not market make to the same extent because of capital requirements. And I think the terminology evolution is maybe very describing, because we all know evolution takes a lot of time. And I think we are just in the beginning of it. I think it takes time when you have had a trading pattern going on in the market for more than 30 years, where buy side go to the sell side and they create the prices. You don't change that overnight. Mm-hmm. It will take 5-10 years, I believe. We now have all these electronic trading venues and platforms coming up. Many of them are very interesting, and we look at them. I think it will take time, because basically what we need to do now is to replace the place we used to have before was the market makers. They created the prices for us. It was outsourced. We cannot rely on that 100% anymore. We have to do something about it. And I think we need a few places where the market agree we go and trade on these places. For different kind of bonds, you maybe go to a different venue. You maybe use a different trading protocol. So basically, the market, there needs to be a winner's course where there's a segmentation of where do the market go and find liquidity, which platform and which protocol. And then secondly, that's not enough, because before we had the market makers, they were very opportunistic. They were warehousing our positions basically on the buy side. Now the buy side has to think differently. If we still want to be an active investor and allocate capital from one end of the market, can be whether within the bond market or from bonds to equity, etc. We need to be more active about our own holdings and provide prices to the market and collaborate very tightly with our portfolio managers so they understand what is possible and what is not possible. And the only way you can tell your portfolio manager that is by being active yourself on the trading desk, providing prices to the market to see what is doable. And that change, I understand, some buy-side say that is completely excluded. We have rules and we have regulation, we can't do it. But my response and answer to that, well, then you need to look at it and explain to those who give you those rules and guidelines. Do you want to be an active manager of this product, yes or no? If yes, we have to do something about the problem and we have to change our behavior gradually, of course, and all these things will take a lot of time. So I think we are just in the beginning of this process.
Mm-hmm. Yann, thank you, Pauli. Yann, do you think that this change in behavior that Pauli is describing, do you think that will include alternative market makers or providers of liquidity to the traditional dealers?
Yes, I would say yes and no. I fully agree with Pauli when Pauli said buy side will have to be much more active than they were up here previously, because search for liquidity is something which is much more time consuming than before. However, depending the type of buy side you are or real investor you are, your role shouldn't be to be a price maker for the market industry. Within ICMA, we have too many funds, too many clients that it will be extremely difficult to put in place all the protocols to be fair and equal in front of all those clients. So that's something which is not so easy, and it's also very linked, extremely linked to the natures of which buy side you are.
Mm-hmm. Mm-hmm. Thank you. Yeah, I think that also gets into the topic really more generally of market structure and business models, and how are they changing? I mean, there's many dimensions that we can discuss for a minute. And is this evolution, this process, with electronification, are we seeing business models change from liquidity provision to price making, as we discussed, of clients, to just skills, resourcing, staffing? Are we seeing those changes? Maybe Nick, maybe you'd like to start with giving us your view.
Obviously, it's a tremendously large question to answer, but I think the insight is, we were talking about liquidity and market making. I think if you look at ESMA and how they've manifested their desires in MiFID II, they are obviously correlating liquidity to transparency, where we have historically understood that liquidity is correlated to the availability of market makers. Now, what interests me is whether increased transparency will allow new entrants in the market making activity, coupled with the tools that are available to them via electronification. So I think the sum of that, the sum of market maker and potential new entries, the availability of transparency, and the utilization of electronification or technical tools in order to complete the circle, I don't know the answer, but I think that's going to be interesting, particularly as we move into the MiFID II space, as to whether we get a shift in the landscape of people who are willing to act as market makers. And the other dimension is obviously technology, and we've spoken about it in a couple of questions, and we've spoken about information, and you yourself very eloquently outlined how you're viewing it as evolving. But technology is also used for efficiencies as well, which has been one of the prime reasons why it's been adopted over the last couple of decades for electronic trading, and indeed ancillary activities around electronic trading. And with efficiencies, you typically get a restructure in terms of the physical warm bodies of staff that were there doing functions previously. So again, from my perspective, MiFID II obviously looms large, and I'm sure it's loomed large over many of the discussions that happened at this particular conference. But how technology is deployed around efficiencies is equally as important a question, I feel, as to impacting market structure, and indeed how participants look in terms of employees, etc., on a forward-looking basis.
Mm-hmm. Thank you. Yann, let's talk specifics. So how has your business model as an investor, how has it changed? What is your workflow of your organization, and how is that different today?
Is it different? You know, we launched a long time ago a strong analytics of our data, of our trading data and all the external data. And that's how do we consume these huge informations we do receive in our system. So there is a big business model which has been put in place within ICMA to develop, a strong IT, which is huge in terms of cost, as well as, human resources to develop these tools. That's something which is really important, because from those data, you can clearly learn from a lot from the market participants, who they are, how they behave, what are the best counterparty which one you can trade with on a specific ISIN for a specific trade with a specific criteria. And working on those retrospective analysis of those market data, it helps us to identify which banks are the best to achieve a strong execution for us and to provide us the liquidity going forward without, impacting negatively the market. That's something which is huge. So for sure, the analytics is, I would say, the post-trade drives the pre-trade, which is something very important to me, because it helps us when you have a juniorization of our trading at the buy side as well. You have to educate them a little bit more and to explain them how you have to behave according to your sell-side behavior as well. That's something which is very important. Mm-hmm. A better knowledge of your counterparty is something which is key to me.
Right. I very much agree with that. I would give, again, the sell-side perspective. When I look back on the last 5 years or so, I think we've come quite a long way in harnessing the value of the data that comes into large firms such as ours, and the information that comes in. And, in my role, the data science hat that I wear as well, my job is really to think about having the appropriate quantitative overlay for every one of our businesses, not just the most liquid, standardized like the CDS index, but everything down to CLOs and tranches. There's a lot of information that comes in the door, and I think that there's a lot of grunt work that goes with that, a lot of data cleansing, scrubbing, putting in the right databases. And those discussions were very foreign to the fixed income markets. They've existed for some time in equities and in FX, but they were very foreign to the fixed income market just a few years ago. And I think that in addition to that, what that's enabling us to do as a sell side is better service our client needs, not only on single bonds, but also to get better about thinking about risk the way our clients do, which is on a portfolio level. And that really was not possible without doing a lot of this, like as I mentioned, this legwork of standardizing and being able to match off bonds and know that the 3 ISINs listed are actually the same bond, et cetera. There's a lot of legwork, but in a capital constrained environment where we have to be more efficient than ever, I think we've come a long way, and there is still more progress to be made on all fronts. But I do find it fascinating on the sell side to see how far we've come in a short time. Yann, I think you had something else you wanted to add.
I just would like also to add some things that basically we all know that all the buy side, we are all profiled by our sell side, to know to serve us in a better way. But what we have to do, it's exactly the opposite. We have also to profile them, to exactly know who they are and how they act. That's something which is very important. It sounds like a TV series, but profiling is something which is really huge when you do strong analytics. It could be per market segment, per size, per any criteria you want to do when you're more seller and buyers. From those market information, you can learn a lot, and as well as give an estimation to your client what should be the predictive prices you could expect based on the historical data you have from your trading experience with that banks. That's something which is really helpful and help us to achieve liquidity without market impact when sometime, I would say, the common RFQ business do not enable you to find liquidity on. That's something which is to me, one of the key things.
Great, thank you. And Deirdre, do you have anything to add to this? And also, I'd be curious for your thoughts on, with these changes, is there room for more retail participation in the fixed income markets as we see in equities?
Okay. I think running an exchange gives you a really interesting kind of macro view of market structure, and I defer to my fellow panelists on how the world is changing very specifically in what they do. But I mean, markets are very simple. They run on the basis of incentive. And incentive is a function of return, risk, and cost. And post-MiFID, EMIR, PD, TD, BAL, QE, etc., every single one of those metrics has fundamentally changed. And I think the big question is, we're never going to put the genie back in the bottle. It's going to be changed for good. So therefore, what we're seeing at the moment is a fundamental realignment of that incentive metric, both for buy, sell, and intermediation. The immediate consequence of that has been what was referred to around market making, and the incentive around market making relative to the risk no longer works from a business model perspective. So how do you replace that and still have some kind of liquidity in a security is the big question going forward. It's very clear to me that when you have this sort of realignment of incentive, a few things happen. Commoditization and the drive towards commoditization is one of the first things. Electronification and using technology to do things quicker and cheaper is obviously the next one, which goes to the topic of this panel. So we're only at the start of this evolution. Unless that value proposition fundamentally changes with respect to either interest rates go way up or our costs go way down, or they decide to give another 10-year delay to MiFID II. I doubt if that would be the case, but unless any of those things happen, we're at the start of a new journey from a market structure perspective. So going to retail, I mean, equity markets have tried to have wider share participation for 100 years and have failed abysmally. And therefore, I think there's always the theory and the ideology versus the reality. I think it's very difficult to see an incentive structure that would work for retail distribution of fixed income, frankly. It's very difficult to see an incentive to buy fixed income from a retail perspective in the absence of there being a tax realignment around fixed income products. I think, though, that there has to be an evolution of collective investment in fixed income and certainly funds products that facilitate retail participation through a funds product. I think that's probably a more realistic objective for participation by retail. But the reality is, and since we're talking about liquidity here, the reality is that if you look at bond markets that aren't market making centric but are liquid, those bond markets tend to have very large retail participation because obviously there's a greater churn in retail participation. They tend to be always corporate bond markets rather than anything more esoteric. And you get better price formation if you've got a large wedge of retail. But I have to say I'm in the skeptical camp on whether you can really create the incentives to allow for broad retail participation in the fixed income market.
Mm-hmm. I would probably agree with you there. I would also make the point, I agree with you as well, that the indirect participation of retail via ETFs, UCITS, the pension funds themselves is probably the more realistic. And when I think about the differences, for example, with the equity versus credit markets, it always strikes me, if we could draw it, it would sort of be like a triangle of participants to instruments and equities, and sort of the reverse of that in the credit markets, of number of participants to number of instruments. And I think that in and of itself makes it very difficult for a number of things, retail participation, and but then also to have this virtuous cycle of firm liquidity, getting everyone to sort of care on, you know, the same bond at the same time. And from that standpoint, you know, we as a bank think that while there's been a lot of discussion as well around the agency model and whether this market is moving agency, I think the fundamental criteria for this to be agency is missing, which is, you know, a small number of instruments with many people with kind of divergent strategies. And I think that also lends itself to the discussion around retail, which makes it more difficult, taking aside, you know, covenants and subordination and term structure and all of the other things that make it harder to, you know a price of a bond and what that means. I think, you know, the bigger hurdle is just the kind of actual market structure itself.
Yes, you can never divorce the secondary market from the primary market if you're talking about liquidity. If you place a security, whether it be an equity or a fixed income security, with pure institutions who want to hold it in a particular portfolio for a long time, it doesn't matter what wonderful electronics you put around it, doesn't matter what you do with it, it's not going to be liquid. And so liquidity doesn't self-create. It is created by the book you have at the beginning, how you've distributed the product, and who is incentivized then to actually churn that product. And if you don't get those things right, it doesn't matter how lovely the technology, frankly.
That's right. So moving on to our last topic of liquidity. Again, I was so inspired by Arunma's comments yesterday that after a few cocktails last night, I did probably one of the more benign things that I could do, and I searched for limericks. And so I'm going to read you a limerick, and we're going to discuss it. I didn't try an interpretation like Arunma, but a patient who kept getting worse said, "I must go home now, nurse. You've done all your best and performed every test, but I've come to the end of my purse." So with that, I'd like to ask Pauli, we've tried a lot. We have many tools now in the markets. Are they addressing the liquidity question or conundrum? Are they making it easier? Discretionary capital has left the system. It's, you know, are we filling that gap, that buffer, with the evolution and all the tools that we now have in the market, or have we come to the end of the road?
Well, I think we have, you're right in saying that a lot have been done. And I hear critics say, yes, we have done a lot now, and we can all see it's not working because we haven't really created much liquidity. But I probably also mentioned before, I think we are really in the startup phase. It takes time. And I think we are going in the right direction. I think both on the buy side and the sell side, there's so many issues on a regulatory front that make us very busy. And it's not always on the top priority of banks and buy side, maybe to push forward in the speed that is required to get liquidity back. But I can't really understand why liquidity should be lower today, ideally, than it would have been 10 years ago when it was really ample. The bond market is as huge as ever. And I think it's very critical that we really think serious about making sure that liquidity is coming back to the market. And we have the technology available. It's just about the winner's course. We need to consolidate it. We need to agree where to meet and to trade. And I think it's both on the buy side and the sell side, there need a change to be done. I mentioned the buy side just before. I think on the sell side, they have to also adapt agency model trading for clients like us. We would like to know when we trade with the buy side, what are we paying for that trade? I mean, today they're making us a markup. We don't know where that markup is. We would like them to trade with us as a pure agent, completely watertight, sheds between them and their own principal trading desks. They can trade with the principal trading desk. They can trade with whoever. They can maybe route the trades to electronic platforms for smaller buy-side clients.
What about when it's a hybrid trade? What about when you call and want to trade 5 million bonds and I can do 2 to work 3, and maybe 2 of them were done on an agency basis, but I'm working more for you? How would that work? in that model?
I mean, I think there's still room for that. But I think you have to still, for me, that would be a choice. Then I'm not going to an agent desk for that type of orders. I'm going to the principal desk. I know they still have some risk allocated to that desk, so I know they can warehouse my positions, I can do something and work it. And so I would say, for me, that would really, I think sell-side principal desks still have a large role to play. There are not many left, but there are still few left that are big and that can, make me a risk price and maybe work 5 and 10, as you mentioned, and work the balance. And as long as there's, I mean, that's basically those where we had plenty of those guys before in the market. We have hundreds, right? Now we have a few. Of course, as long as we have those players, we should use them for what they are worth.
And I'd like to ask you a question or throw this out there to you or any of the panelists. How much do you think, I mean, obviously it's indisputable that there's been a pullback from certain banks in their principal market making, but when we think about, capital commitment to the market, we don't just think about the actual, balance sheet that we're committing, we really look at turnover. And for us as a bank, our turnover metrics have actually gotten better, since the crisis, they've gotten better and better. And so how much do you think that all of these tools, these evolution, checking now not just with dealers primarily, but also going to clients, when you think that runs don't work or a dealer's not willing to take a trade that they used to, or et cetera, how much of that do you think is true pullback of balance sheet, and how much do you think might be also the cause of dealers now in certain instances feeling like the trade of last resort? In other words, a bond has been shopped around, and now their run, which might have worked if they were the first call, might not work because they think, whether right or wrong, they think that they're the 5th or 6th call. Anyway, Pauli or
well,
Yann?
I think that's really depends on the relationship you have with your counterparties. I mean, I don't think I have a relationship with any of my counterparties where they are the last call, because my relationship would be with the principal trading desk would be, I come to you because I know you can warehouse risk, you can make me good prices, and if you not can take it all, I also know that I can trust you. So either, I do a certain amount with you and I can go to the next guy, and I will then reveal for the next guy, I traded a couple with the first guy, this guy has done what is good for him, no market impact, and now I can work with you. I mean, that's all about the relationship building. If you don't have that, you will sooner or later get a lot of problems with your counterparties.
Yes, I do think that we're now more partners than ever with our clients in that regard. Again, my sell-side perspective is that much has been written about the pullback of capital, that I think, as we talked about earlier, data and the availability of data coupled with many options now in protocols, I do think that we're in this funny state, as you mentioned, we're not to the kind of equilibrium end state where people know which bonds, which protocols are being used, et cetera. And I do think that at least, there's no way to prove it, but I do think at least some of what's reported as dealer pullback is also, certainly not with our best customers, but I think there's a general sense maybe in the market as well that we don't know in the dealer community where the bond has been shown before, and that's also at least contributing to either wider bid-offer spreads or runs not working. Yann, would you like to add something?
Yeah, I think one thing to consider is the pro-simple trading never totally disappeared, is that still exists, but due to the huge cost and regulatory pressures, the banks are offering liquidity for the clients which are profitable for them. That's one of the key things. And buy side also to understand that the liquidity is not for free. And as far as you agree to pay a price concessions to have a big block being done compared to the screen price you can see on any vendors, screens, you've got your liquidity. There is a confusion between, widening in spread or bid offer and illiquidity. It's not because the price are moving up or down that the liquidity is not for there. I can give you an example. One of the biggest trade I did on corporate recently was 110 million euro corporate single A, just traded with a slippage of 30 cents, which is crazy nothing compared to the size and the sensitivity of the market by the first 3 months in 2016. That's something you have the liquidity. I found based on my analytics, I identified the good counterparty I was keen to trade with. That's something which were really interesting for that. And I got the liquidity, but not at the screen price.
Mm-hmm. Interesting. Thank you for sharing that perspective. Nick, there are many concerns looming in the near future. Brexit, the U.S. elections, uncertainty with China. Many of these obviously may cause volatility. From what you hear, your firm speaks to investors, they speak to the sell side. Does the market community at large, do we feel that the evolution of the market has left us better equipped to handle such market shocks?
I think this, for me, is again correlated to transparency. So I would say that the actual outcome of any of those events and how they would impact the market is obviously highly varied, but our ability to deal with them with respect to the available information on the events and how it's impacting the core product you've got an interest in, or indeed related products, is very high. And the technical capabilities we've got to transact around that or analyse it is equally as high as well. So I think technology and electronification has put us in a better place to at least comprehend and respond against them. But obviously that depends on the scale of the issue itself.
Mm-hmm. Great. And Yann, what do you think on this topic? And do you think that there's, in the event of a shock, do you think that liquidity migrates to other asset classes, or are we living in an environment with the correlation of asset price movements across markets is really the most concerning thing? And if so, are any of these advances really helping us?
Just to come back on what Nick says as well, the market data, also what you do of the market data is something which is extremely huge, because misuse of the sensitive market data, yes, following the post-trade transparency as well, it could be something which could decrease liquidity forward, because some ruthless users can use it negatively and impact negatively the market as well, which will be going forward a decreasing of liquidity for everybody. So that's something where I think everybody is concerned about the extending reporting by 48 hours, which is something maybe a little bit small or low, short for some of the big trades which have been done. So,
what do you think is the appropriate framework?
I would say maybe not to provide full side, to extend up to 3 or 4 weeks, and also to have a coordination across all European regulators as well, because it's unclear to me where the French, Belgium and so on, or maybe the FCA as well, how they will interact together to decide if yes or not, they will decide to put a temporary exemption to 3 or 4 weeks, which could exist, but there is no real clear, requirements in that.
Yes, got it. Nick, you wanted to add something?
So, Yann, are you referring to, obviously, the transparency in the MiFID II state?
Yeah, as a post-trade, yeah.
I think one thing that concerns me about transparency under MiFID II in the post-trade space is the fact that the deferral scenario that you were talking about is actually on a per NCA basis. So as well as the challenges that you highlighted with regards to making sure that there is appropriate deferrals at any given time, one of the challenges that faces the market is to make sure that those deferrals are uniform across the EU, because obviously we don't know how it's going to play out now, and indeed if the NCAs are going to cooperate in this fashion. But it is entirely possible that more generous deferrals are given in one jurisdiction versus another jurisdiction, and I think that's concerning to the sum of the market, because obviously there might be a slew of activity towards the more generous jurisdiction. And just another point, if I may. Historically, there's been a lot of talk about an arms race, notably in the sell side with regards to price making and obviously latency sensitive. And kind of a question for Yann and Pauli, really. Do you think there's a potential for an arms race in the consumption of information from the buy side, where historically they've not really invested in the scale of technology that the sell side have had to do to achieve that level of sophistication?
I don't think it's so relevant in our space, because it's a very low latency trading environment. So I think the advantage of having this information is very limited compared to the equity world, where the importance of getting information very fast and respond very fast is playing a much more key role. I would like to add another comment. I fully agree with the concerns on the post-trade transparency, but I also would like to highlight a very positive impact from post-trade transparency. And that is one of the issues we see today with matching in dark pools is that buy side are having offset interests, but they do not meet and they do not trade even though they have offsetting interests because they cannot agree where is the price. And that's something that post-trade transparency really will help with. I think anyone on the buy side would be happy to trade on a mid-market, but they don't agree on the mid-market and no trades take place. So I think that's something that can really kickstart some of these new alternative protocols for fixed income when we get MiFID II.
It's interesting because bringing in the U.S. perspective, where we have Trace, we have post-trade transparency, and these same protocols are being tried, in the U.S. As they are in Europe. And there may be slightly more trading, but I personally don't think there's a meaningful uptick because, again, going back to our earlier comments, I think that the problem that we've learned of going through the evolution of the markets, I think that the core problem that we learned is it's actually not, we've now built all the tools to connect each other, build the street corner, agree on a price. I think the market's just, everyone's going the same way. So we might all agree that the bond is 90, and I think it's, these platforms aren't necessarily disclosing what the buy-sell imbalance is, but I suspect that the price may be a factor, but it's a much smaller factor than the fact that the markets are more herded than ever. People are all pursuing the same strategies with the same targets. So I personally think, yes, there may be a limited upside in Europe, but learning from the U.S. experience, I don't think it's going to be as significant as one might hope. But we're running to the end of our time, so I'd like to open it up for any questions.
Hello. I just wanted to go back to the increasing the retail investor base question, and the earlier panel discussed Robo Advisors. So I was wondering if you think that could have an effect, especially since you mentioned that going through ETFs and funds was a way to increase the retail investor base. Do you think the Robo Advisors, increasing the Robo Advisors could affect increase in the retail investor base? Especially if you're familiar with statistics, I'd be curious to know how that has increased. And because I know that in the United States there are many companies that offer such services. I don't know to what extent that's the case in Europe. Thank you.
Being honest, I'm not familiar with that construct. I've only ever looked at fixed income in the context of European distribution channels. I suppose I'd answer in a more general way, which is one of the issues you have, whether it be with any asset type from a retail perspective, is distribution. And how do you incentivize somebody to distribute this product versus another one that they might get a bigger commission on? And that really is the fundamental. And then on the other side, how do you have a saver looking at this product versus another product and saying, okay, well, that's something I'd like to have in my portfolio. So it is as simple, and I know that's very simplistic, but it is as simple as that. So I think Europe has a deficit of distribution channels to the retail investor. The banks aren't in any way as proactive as they are in other parts of the world. And we have seen a clear out of that sort of retail ecosystem over the last 10 years. And that used to service the equity market from a retail perspective, and now because the incentives have gone, they basically have moved on to other things like wealth management, etc. So there is a deficit. So therefore, I suppose the only answer I would give you is anything would be a positive, because I think there's a massive deficit.
Okay, I think we're just out of time. If there's any last question, we're happy to take one more. And how the future will be impacted by
trading being involved in fixed income markets will be affecting.
Sure. I'll start with a quick comment from the sell side on this. I think that high frequency is a very small component in the fixed income markets and certain rates markets, perhaps at some juncture the CDS index market. But I think, again, going back to the number of instruments versus participants versus, how much active interest there is, away from those two, highly commoditized markets, it will, probably play a more limited role. And I think that the dark pool, gray pool matching, I think actually lends itself to the less liquid spectrum with respect to fixed income, where what we see as the interest in those is when, dealers aren't making markets, or it's a bond that's not actively quoted, or a client has large size and doesn't want to reveal their hand on something that never trades. So I think that with respect to dark gray pools, my personal opinion is that there will be limited, if any, concern around high frequency trading in the fixed income space.
So I would just add to that. I think the increased availability of information at first glance may lead you to conclude that HFT activities will be more achievable in fixed income. But I think HFT is much more correlated to the protocols which are used for fixed income execution. If we were trading fixed income products on central limit order books, then HFT would clearly be achievable. But we're not. We're predominantly trading fixed income products on RFQ. And it's actually the nature of the protocol which I think is the largest hurdle for HFT adoption. Yes, we've got the information thing somewhat solved, but it's the protocol which is the hang-up. So if we see the market changing protocols, perhaps adopting central limit order books in the more standardized products, or indeed a rise of dark pools or grey pools where the active execution around those pools is sufficient enough to support high-frequency execution, that, I think, is the trigger point where you will see high-frequency trading adoption within fixed income.
Mm-hmm. Great. I apologize. I think that we are now out of time. I want to thank my panelists as well as ICMA. I think this is a great discussion, so thank you.
Thank you.